Welcome back as we move on to examine the relationship between economic expectations and the nominal risk-free rate. We'll learn the components of the nominal risk-free rate and the Taylor rule for setting policy rates. We'll also learn what the break-even inflation rate is and how the business cycle affects the yield curve. Let's get started. In the last lesson, we've learned that the real risk-free rate of the market is positively related to the expected GDP growth of the economy and the expected volatility of GDP growth. We've made this argument based on an assumption that there is no inflation. In practice, where this assumption is not valid, the real risk-free rate can be observed in the yields from government-issued default-free inflation-linked bonds like TIPS from the US Treasury. As the cash flows are indexed to the inflation rate, the real yield of the bond can be argued to reflate the market's real risk-free rate. Following the 2008 global financial crisis, it can be argued that the real yields on TIPS would increase as the expectation of higher volatility in GDP growth. However, the real yield on TIPS actually went negative. This may be explained by lower expectation of future real GDP growth. Also, it's important to note that inflation-linked bonds are often in limited supply, so in times of crisis, investors may see them as a safe haven, which can drive down their yields. This may explain why the real yield of US TIPS went negative. Next, let's move on to study the effect of economic factors on nominal risk-free interest rates. Nominal rates include a risk premium for expected inflation, which we denote using the symbol theta. For short-term risk-free securities like US T-bills, the discount rate is therefore the nominal interest rate, which is comprised of real risk-free rate and expected inflation. The price of a T-bill is simply the expected cash flows discounted by the nominal risk-free rate. However, do note that inflation is uncertain in the long term, so for longer-term bonds, we add a risk premium for inflation uncertainty, which we denote using the Greek letter pi. The nominal risk-free rate for long-term risk-free bonds is therefore the sum of the real rate, inflation expectation, plus the risk premium for inflation uncertainty. The price of a default-free coupon-paying bond is therefore the sum of the future's cash flows discounted by the nominal risk-free rate. So based on these arguments, we would expect the short-term nominal risk-free rate of an economy to be higher in economies with higher, more volatile GDP growth and with higher levels of inflation over time. In practice, it is observed that the 3-month US T-bill rate, a proxy for the 3-month nominal risk-free rate, shows close relationship to the inflation rate. This is also because the 3-month US T-bill rate is strongly influenced by the policy rate set by the Federal Reserve. When inflation is high, the central bank raised policy rates to dampen economic activity in order to lower inflation. The Taylor rule is a tool to help policymakers determine an appropriate level to set the policy rate to achieve the dual objective of maintaining price stability and achieving maximum sustainable level of employment. Central banks typically have a target inflation rate and an estimate of the potential GDP of the economy. Based on Taylor rule, the appropriate policy rate is calculated using this formula. If inflation and/or output is higher than the targets, the policy rate should be raised to dampen economic activity. The short-term real rate here refers to the rate that balances long-term savings and borrowing in the economy. If we sum this short-term real rate with the target inflation, we get the neutral policy rate. That is, the policy rate that neither spurs nor impedes real economic activity. For example, if the real rate is 1% and target inflation is 2%, the neutral rate should be 3%. However, if expected inflation is 2.5%, which is higher than the target, and the output gap is 0.5%, then the appropriate policy rate in the Taylor rule would be 4%. The central bank should raise its policy rate above its neutral rate to bring down inflation and reduce the output gap. In summary, short-term market default-free nominal interest rates tend to be very heavily influenced by the inflation environment and inflation expectations over time. But they will also be influenced by real economic activity, which in turn is influenced by the consumption and investment decisions of households. But these interest rates will also be affected by the central bank's policy rate, which is influenced by the level of inflation expectation and output gap in the economy based on Taylor's rule. Do be very clear of the relationships between all these elements. Next, let's learn what the break-even inflation rate is. We've learned that the real risk-free rate can be observed in the real yield of government-issued inflation-linked bonds, while the nominal risk-free rate can be observed in the yield of a government bond. The difference between the two yields for bonds of the same maturity is known as the break-even inflation rate. For example, if the real yield of a 10-year TIPS is 1% and the yield on a 10-year T-bond is 3%, the 10-year BEI for US Treasuries is therefore 2%. As you can see, the BEI incorporates the inflation expectations of investors, plus a risk premium for investors' view on inflation uncertainty for longer-term bonds. The BEI is useful to central banks as it is a measure of market expectations of future inflation. A figure that is significantly higher than the central bank's estimates would require attention, as inflation tends to play out according to expectations, something we've learned in Level 1 economics. However, one should also note that the BEI incorporates a risk premium to compensate investors for inflation uncertainty, so the BEI should likely be higher than actual inflation expectations. So far, we've discussed the fundamental pricing relationship for default-free real and nominal bonds and nominal interest rates. We now elaborate on these relationships over different investment horizons. The yield curve is the plot of yields of risk-free bonds of different maturities. As we've learned earlier, the nominal interest rate is predominantly a factor of the GDP growth expectations and inflation expectations. The term spread is the difference between the yield on a longer-term bond and the yield on a short-term bond. Evidence suggests that normal term spread is positive, so the yield curve is normally upward sloping. This may be because the risk premium for uncertainty in inflation is higher for longer maturity bonds. However, the slope of the yield curve can change due to changes in expectations. We have earlier explained that short nominal risk-free rates tend to closely track the policy rate. When a central bank raises the policy rate to lower inflation, the short rate rises and longer-term inflation expectations fall. In general, the late stages of a business expansion are often characterized by a peak in inflation and an aggressive increase in policy rate by the central bank to bring down inflation. If longer maturity yields reflect lower inflation rates and diminished business credit demand, the yield curve would tend to flatten or invert, reflecting investors' expectations of lower long-term GDP growth and inflation rates. An inverted yield curve is often perceived as a predictor of recession. But do be aware of the limitations of reading too much into the shape of the yield curve, which in practice depends on a complex mix of interest rate expectations and risk premium considerations. Moreover, the sovereign bond market can also be influenced by supply and demand factors that may move yields in ways that do not appear to be consistent with the business cycle. Sometimes yield drops not because of economic factors, but because of demand exceeding supply. This can happen due to stock market or geopolitical turmoil, where investors flock to safe government bonds. And that concludes our study on the nominal risk-free rate and its relations with economic expectations. Next, we'll learn the credit risk premium. See you again.